Fed likely to end bank funding program in March, Wrightson says. The growing gap between the rate on the Federal Reserve's nascent funding facility and what the central bank pays institutions' parking reserves suggests officials will let the program expire in March, according to Wrightson ICAP. The Fed introduced the Bank Term Funding Program, or BTFP, earlier this year as the banking crisis roiled markets. The program allows banks and credit unions to borrow funds for up to 1 year, pledging U.S. Treasuries and agency debt as collateral valued at par. The rate for these loans, 1-year overnight index swaps plus 10 basis points, is currently 4.84% and 56 basis points lower than the rate for interest on reserve balances. Yen rally looks fragile to Jefferies as money managers pile in. For currency traders betting on the yen rally, Jefferies LLC has a warning: don't get carried away. The Japanese currency has advanced more than 6% against the dollar from its November low, but if history is any guide, positioning indicates that the run is near its end, according to Brad Bechtel, the global head of foreign exchange at Jefferies. That's because when institutional investors turned bullish on the yen over the past year, it soon went into retreat. Biggest losers, Bullion, and black gold all bid on Boxing Day. The S&P 500 is now up over 15% since October 27. And the Santa rally markets have been experiencing since just before Thanksgiving continues even after he dropped his presence around the world on Monday and faces the Boxing Day hangover. Strong consumer spending in stores, 12-14, retail sales accelerate in November on sequential basis. A rapid deceleration of inflation, 12-22, core PCE inflation falls further, and a dovish tilt from the Fed, 12-13 FOMC dots and the market shrugging off the post-FOMC jawboning. The days that moved the U.S. market in 2023. In 2023, S&P 500 has bounced back from the difficult environment in 2022 that saw a decline of more than 19%. Year to date, the index has been closing with 132 positive days and 113 negative. Last year we saw 122 trading days with swings beyond 1%, and 2023 is looking to end around half of that number. 20th of December the count was 63, which is more in line with the 10-year average of 59. Key drivers for the large swing days have been mega-cap tech stocks' performance, banking turbulence, and the Fed's inflation battle. These factors shape the trajectory of market returns, where the top 10 performing days contributed an aggregate increase of 18.35% to the index, in contrast to the bottom 10 days, which saw a collective decrease of 16.20%. The biggest risk in 2024. In late 2019, The Economist put out a 150-page report called The World in 2020 that offered some predictions for the coming year in geopolitics and the economy. The issue was full of thoughts and ideas from CEOs, economists, scientists, politicians and business leaders about what was coming in the year ahead. These thought leaders were worried about the lasting impacts of Brexit, the upcoming U.S. presidential election, China's role as a global superpower, climate change and more. They weren't worried too much about a recession or a stock market crash or anything related to a healthcare panic. Thank you.